What's up, everybody? It is December, so it is once again time for two deep value stocks for the month of December. This is something that we do on the channel every month. I like to share two companies that I think could be cheap, and I like to show off companies that I think you're not going to hear about on other channels. I try to find ideas that are new and interesting. So yes, we could talk about Molina Healthcare again, or Nomad Foods, or maybe we could talk about PayPal. All of these companies I think are trading for very interesting valuations right now. These are companies I own in my portfolio, but we've talked about these companies multiple times before. I want to share something a little bit different with you all today. So to start with, the first company is going to be a stock that I've been buying. I mentioned it once before on the channel, but it's probably unknown to most people. The second stock is one I don't own, but it's had quite a tumble recently. It's looking cheap by the numbers, so we're going to dive in and see if there's value there. As always, if you get value out of the video, subscribe to the channel. If you want to make spreadsheets like the ones that I have here, or if you just want to support what I do, consider following me on Patreon. Link to that will be down below. Now, let's get started with the first stock, and it is PetroTal. I think I've mentioned this company only once in a previous video when I talked about my thesis on the oil industry as a whole and some small cap upstream oil producers that I own. Companies like Vital Energy and Baytex I mentioned. Many of the stocks I own in this space have gone up quite nicely from where I was buying, but PetroTal is not one of them. This is one of the few stocks in the sector where I'm down from where I was buying in, a little over 30% on price. Once you factor in the dividend they paid out in that time, it's a little less than 30%, but regardless, I'm down on this position. Now, there's some real reasons why the stock sold off. Their last earnings report was not great. The company has some problems for sure, but I think this company right now is simply way too cheap relative to their assets, their oil reserves, pretty much any metric you want to look at. This company looks dirt cheap. They're trading for less than 2 times enterprise value to EBITDA. They're trading for, 3 to 4 times last year's earnings. And this is a company that has a net cash position. That's not something you often see with an oil producer. Oil production is very capital intensive. You have to drill wells before you get revenue coming out of those wells. A lot of these companies have significant amounts of debt. PetroTal has close to no long-term debt. I mean, they have a little bit, but it's less than their cash position. Management has been quite conservative with how they've been treating their balance sheet. Now, diving into the business, the main asset here is the Britannia field, which is essentially in the Peruvian Amazon. So production here is in Peru. It's in South America. You're taking on some geographic risk. But the company has been extremely well managed. Again, they have a net cash position. They have not taken on significant debt. They've been returning a ton of capital to shareholders in the form of dividends. We'll talk about how that's changing going forward. Meanwhile, they've been increasing production significantly since 2017, 2018, when this company came into existence. We see here every year production going up, 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 and up. And their costs are reasonable. Even in today's low oil environment, they're producing quite a profit. Year-to-date free cash flow, roughly $87 million. Again, this is a company that is trading for a market cap and an enterprise value of roughly $250 million. On top of this, something always to look at with oil companies are what do the reserves look like? A company can have decent cash flow, but if there isn't that much stuff left in the ground, then the future prospects of the business might not be great. PetroTal has 67 million barrels of 1P reserves. 1P are proved reserves. 2P are proved and probable. 114 million barrels of proved and probable reserves. This is a massive amount of oil for a company the size of PetroTal, a company trading for an enterprise value of roughly $250 million. The after-tax 2P PV10, which I know that's kind of a mouthful. What that means is PV10 is the present value of, in this case, the 2P, so proved and probable reserves, the present value of that. So you take the cash flow that you're going to get over time from proved and probable reserves, and you discount all that back to today at a 10% discount rate. So what is the present value, the PV10, present value with a 10% discount rate of these 2P reserves? And the valuation there is $1.7 billion. Again, this is a company with an enterprise value of roughly $250 million. It's not even trading for 1/6 of its 2P PV10. I look at a number of oil companies. I do not know of a company with a cheaper enterprise value to PV10 valuation out there. If you know of one, please put it down in the comments. I would love to look at that company. So pretty much regardless of how you slice it, if you look at enterprise value to PV10, you look at enterprise value to EBITDA, you look at enterprise value to barrel of flowing oil, whatever metric you want to look at, PetroTal looks dirt cheap, and it's well run with effectively no debt. So, what is the problem here? Why is the stock so cheap? And now I think it's time we talk about the issues, because there are issues here. There is a reason why the stock dropped, roughly 40% since their last earnings report. First, CapEx is going to go up. They need better water handling. Producing oil requires quite a lot of water use. As you build out development, as you scale up productions, you're going to need more water. You need a way of dealing with the wastewater as well. And on top of water handling, they also have to pay money for erosion control. Again, most of their production is in the Amazon. There's a big wet season that can cause the river to erode. They use that river for transporting their oil by boat. So, they're investing quite a bit of money coming up in erosion control. Meanwhile, at the same time that you have CapEx increasing, you have production coming down. When you drill oil wells, there's a natural decline rate. You get the most oil coming right away, right after you drill the well. And then, a year later, you get less oil. 2 years after that, you get less still. That's called the decline rate of the well. And with PetroTal, these are conventional oil wells. So the decline rate isn't super steep, with some oil producers, especially with producers in Texas in the Permian Basin. If you're drilling into these shale rock formations, you can get really, really steep decline rates. PetroTal, conventional oil, not super steep, but still, if you don't drill more wells, your production is going to fall off. Previously, PetroTal said they were going to have a rig to the Britannia field end of 2025, end of this year. Now that's been delayed. They're now saying the rig is not going to get there until mid-2026, and they can't start drilling there before then. And this is a company that has been able to increase production every single year. And now it seems 2026, production is going to decrease. So with less production on top of the CapEx demands that they have coming up, the cash flow is not going to look as good for the first half of 2026. Now, I think many companies in a similar situation, especially many American companies, would probably look to take on some debt. But PetroTal has always been very prudent in how they manage their balance sheet. So what they've done is they've decided to cut the dividend. They've paid somewhere around a $50 million dividend for 3 years. They say they distributed over $144 million in dividends since the beginning of 2023. So pretty much they've paid out about 60% of their current market cap in dividends just over the past 3 years. This has been very attractive to a lot of investors. And, once that dividend goes away, it doesn't really matter if the intrinsic value of the business still looks, like there might be value there. When there's a dividend cut, you are going to have people fleeing the stock. And that's what we've seen. In fact, if you just look at the volume here, there isn't much volume on this stock in general, but over 6 million shares traded on the day that they announced this. The stock was down massively and it's drifted a bit lower since. And while we're on the subject of volume and trading, another reason why I think this stock is just so dirt cheap is it does not trade on a major American exchange. If you want to buy PetroTal, you have to buy it on the Toronto Stock Exchange or over the counter. It trades under the ticker symbol PTALF over the counter. On the Toronto Stock Exchange, it is TAL, TAL. Regardless of where you're buying this thing, the liquidity is very low, the volume is low. There is simply no one that cares about this name. Now, another thing we should talk about, obviously, is oil prices. PetroTal cannot control the price of oil, but their business, their revenues, their cash flow is heavily dependent on it. Oil prices are very low right now. This chart here is showing inflation-adjusted West Texas Intermediate WTI prices. I should probably show you Brent prices. That's a more appropriate benchmark for a company like PetroTal, but there's really not much difference between the two, a few bucks. And I had this inflation-adjusted graph ready to go. So here we are. West Texas Intermediate prices. We see right now trading just about $60 a barrel of oil, and that's not that expensive. I don't think many people have great track record predicting the price of oil. Tons of analysts try to do it. Oil is very cyclical. Like any commodity, it depends on supply and demand. U.S. production seems to be peaking. We might have a bit of oversupply. I don't want to get too deep into the oil market. Prices might remain under pressure for some time. I have no better ability to predict oil prices than anyone else. However, I think in 5 years, oil prices will likely be higher than they are today. Obviously, I don't know that, but when I think about risk reward, a company with essentially no debt like PetroTal is better able to handle these low price environments than someone who's very levered up. They're still profitable at $60 oil. And if oil goes back to, $100-ish a barrel, which wouldn't even really be expensive, historically speaking. But if that happens at around $100 a barrel, a company like PetroTal, they're probably making close to $200 million in free cash flow for the year. Again, I want to reiterate, this is a company that is trading for a market cap of $250 million. Obviously, with a small cap oil producer, especially one that has political risk, it's in South America, Anything can happen, but I think the risk reward is incredibly asymmetric in our favor. This is a small position in my portfolio. It's currently under 1%, but yes, I've been buying more this past week. At current prices, I would like to continue building my position. In spite of the challenges that the company is facing, I don't think a 40% sell-off was warranted. I think this is because they suspended the dividend. That scares people, but management has run this business well in the past. They don't want to risk taking on debt here. They want to be able to survive with just their cash flow. A company with this large of oil reserves trading for such a cheap price, it's really difficult to find. So those are my thoughts on PetroTal. Again, this is just my opinion. This is not advice for you to buy or sell this stock. Again, I own PetroTal currently. I may be biased because of that. I'm just giving you my opinion and I'm telling you what I'm doing with my money and I'm adding here. Now, let's jump into the second company. And this is not a company I own. It is Bath and Body Works, ticker symbol BBWI. It's a company I've looked at before when it was around $25 to $30 a share. And my opinion at the time was basically, yeah, it looks cheap, but there's a lot of reasons why it probably should trade for a cheap multiple. And it just wasn't cheap enough for me. Well, they just reported earnings and the stock is down, about 17-ish% now from where they reported. It was down more like 30% in the couple days after earnings, still down about 30% over the past month. A couple people have asked me to take a look at this company, and certainly by the numbers, it does look cheap, trading for a PE ratio of just about 5 times earnings right now. With the price down so much, I think we should see what happened, what did this quarter look like, what is the company guiding for, and is there possibly value here? I think most people in the US are probably going to be familiar with this company, but if you're outside the US or you just maybe haven't heard of them before, they basically make things that smell good. They sell fragrances, a lot of people know them because they sell these candles. They also sell soaps and shampoos, things like that. I would consider them a pretty well-known brand. They've been around for a while. And when you look at the numbers, I just brought them into my sheet here, which, by the way, shameless promo on Patreon, you can get access to my templates. So, if I just zero this out here, if I just put in some nonsense ticker just to clear our info here, how it works is you just put the ticker in here, in this case BBWI, and I'm going to hit load to load all of our data. And the sheet here, my template, is going to load in a bunch of information about the stock. We see first here, the price chart. Price has been all over the place. They hit a low of in the single digits in COVID, and then they went all the way up to right about $80 a share, now down to 17. So certainly been a roller coaster ride if you've been invested in Bath and Body Works. The first thing you're going to notice looking at this sheet is, what happened to the revenue here? Revenue was kind of just slowly growing, and then, well, obviously this was COVID. Okay, there was a big drop, but what's going on? The numbers here on the right do not look like they're from the same company as the numbers here on the left. And if you thought that, you would be half right. Bath and Body Works, I feel like every time I say that, I want to say Bed Bath and Body Works. But in any case, Bath and Body Works, prior to this point, they were part of a company, L Brands, which also included Victoria's Secret. They split off. So the numbers you're seeing here from 2020 and beyond, this is just Bath and Body Works. Naturally, they had a slump in COVID. It looks like they recovered, but they've actually kind of been slowly trending down ever since 2022. And at the same time, margins have also been trending down since 2022. We see, 2021, 2022 margins, operating margins about 25%, and now they're drifting down. They're about 17% now. And you might look at what they were before in the 20 teens and see, they were about 17-ish% there. So it looks like margins have been consistent. But prior to this, again, this included Victoria's Secret. Victoria's Secret is actually a lower operating margin company than Bath and Body Works. So during this time in the 20 teens, the Bath and Body Works segment of this business, it had higher operating margins than they currently have now. Operating margins have gone down over time. On top of this, another thing to note, they have a reasonably significant amount of debt here. I mean, $3.5 billion in net debt. It's pretty significant. Again, the market cap of the company is about $3.5 billion. They do have a decent amount of cash flow, a decent amount of operating income, but still $3.5 billion of net debt. Pretty significant for a company of this size. Now, speaking of cash flow, the reason why I think a lot of investors would be interested in this company is if you just look at their adjusted free cash flow, and again, for people who don't follow the channel regularly, adjusted free cash flow for me, It's just free cash flow minus share-based compensation. Share-based compensation, that is a real expense to us equity owners. Free cash flow does not take that into account. So, I net that out. And when you look at the adjusted free cash flow for Bath & Body Works, it looks pretty good. I mean, we've been looking over the past few years, $600 to $800 million. And this is a stock that, again, is trading for $3.5 billion. Right now, this is a free cash flow yield of 20%. That is insanely high. Essentially, if they're just able to continue business as usual for 5 years, they would make as much money as the current market cap of the entire business. On top of that, return on invested capital looks incredibly high. Operating margin, we said it's been coming down, but still 17% operating margins for a business like this, where you're basically just producing candles and shampoo and stuff like that. These are really pretty good margins, and they do demonstrate that the brand has some brand power. So those are the positives. That's the good side of this. But now we have to talk about the issues. There is a reason why the stock is certainly down a bunch. We said if they could just maintain business as usual for 5 years, then yeah, Bath & Body Works looks like a huge bargain. But can they really do that? Can they actually maintain their top line, maintain their earnings, their margins? And that brings us to their third quarter earnings, which, this just came out a little more than a week ago, week to two ago. This earnings report was pretty ugly. So in the quarter, sales are down year over year. Margins are down significantly year over year. And what that means is translating to operating income down 26% year over year. That's quite a lot. And keep in mind, during this time, sales are down 1% while they've actually been increasing the store count. That's obviously not what we want to see, and it's significantly different than what management was guiding for. Management was guiding for the top line to be up, 1 to 3%, and it turns out they're down 1%. That's a pretty significant miss. Guidance was also for gross profit to be about 100 basis points higher than it actually ended up being. So definitely some weakness there, but this actually isn't even the worst of the news. Management said our start to the holiday in late October has been very challenging. Looking at their guidance for Q4, and by the way, for companies like this, Q4, this is really where most of these businesses make a ton of their money for the holidays. Q4 is the most important quarter for a retail brand, and the guidance here is really disappointing. They're guiding for net sales top line to be down high single digits. Macro consumer sentiment is weighing heavily on our consumers' purchase intent. That sounds like a lot of corporate speak for basically people aren't buying our products as much. Early indicators pointing to a highly competitive holiday season. For full year guidance, they're bringing down a number of metrics. Just last quarter, they were guiding for free cash flow of $750 million to $850 million. Again, for a $3.5 billion business, you're talking about a free cash flow yield, if those numbers were to come true, in the low 20%, more than a 20% free cash flow yield. Now they're guiding for free cash flow of $650 million. Still, that's something like, an 18-ish% free cash flow yield, but you can't like the trend here. Adjusted earnings per share of, they say, at least $2.87. So, relative to the current stock price of 17 and change, trading for 6 times earnings. Now, whenever a company reports something like adjusted whatever, you always should look up that metric. Adjusted metrics, those aren't standard accounting metrics. The company can put whatever they want basically into those adjustments. However, companies are required to disclose, how they came up with their adjustments. What are they doing to adjust? In this case, there's no huge line item that's going into the adjustment that's changing the numbers dramatically. We see here forecasted earnings per diluted share of $2.83, and their adjustment after a couple things is $2.87. So not a big difference. The adjustments are reasonable. I just always recommend that you go and look and just see, what's going on in there, because sometimes companies adjust for ridiculous things. So while the company looks cheap based on earnings, based on free cash flow, we have to ask ourselves, what does the future of this business look like? Do we think they're going to continue to decline significantly? Because, they're guiding for decline of high single digits on the top line in the fourth quarter. If they're losing high single digits of business every year, that's probably not a business we want to be invested in. It looks like over the past few years, they've been declining more like low single digits. And I should point out, they just had a new CEO come in back in May. So the third quarter, their earnings that were just reported, this was his first full quarter as CEO. It's not uncommon when a new CEO comes in that they'll often try to undersell to downplay the business. It just makes their comps in the future look better. It's something that we see quite frequently with CEOs. That way, if it turns out, Q4 is only down 4 or 5% year over year, the CEO can just say, hey, look how great I am leading this business. Now, on the earnings call, they talked a bit about how they feel like they're losing new, younger customers. That does roughly align with my sense of the brand. I think of the company as appealing to, middle-aged and up, and primarily a female demographic. If you're a younger person, let's say under the age of 30, I would love to know, what is your sense of Bath & Body Works? Have you shopped there? Do you know people who have? What are your opinions of the stores? I'm genuinely trying to know, because when I see a company with 20-ish% free cash flow yield, obviously I'm going to be interested. I'm thinking about the risk reward and the future prospects here. And I have to say, to me, going through the earnings call, there wasn't a lot that I liked. They talk about new products, engaging younger customers, reigniting our brand and cultural relevance. But you know what I hear with a lot of this is I hear that CapEx is probably going to go up. They're going to try to advertise to different demographics, invest in changing the store and product line. But there's a lot of uncertainty there as to, whether customers are going to respond to that. Sometimes when a brand or retailer is stagnant, trying to reinvent yourself can be a risky strategy. Simply trying to control costs and stay in your lane can be a way to go as well. We looked recently at the earnings call of Kohl's, which is a retailer, quite a stagnant brand. Low single-digit declines. They've been trying to reinvent themselves over recent years. And this year, throughout most of 2025, they've just been getting back to the basics of retail, just trying to stay in their lane, control costs, remain disciplined, do what they do. And yeah, if they're down low single digits, this can still be a profitable investment. And for us, Kohl's has been roughly a triple this year. So you can make money with these boring, stagnant brands. One thing that was exciting maybe on the call is they say that they're expanding into certain marketplaces, including specifically Amazon, expected to go live in the first half of 2026. And they do talk a bit about cost savings and optimization. And, for a company that's trading for 6-ish times earnings, 18-ish% free cash flow yield, we'll call it, there might be value here. So let's go to our sheet and let's put some numbers in for assumptions for the future and see, what we could expect for a return on our investment in Bath & Body Works. So looking through all their financials and hearing what management is saying, I'm giving them a 4% decline every year for the next 5 years. I think that's a reasonable expectation. Pulling margins back just slightly, putting them at 16%. They are still going to be returning a decent amount of cash flow to shareholders, I imagine. And I'm giving them only a 6 times multiple on operating income in this scenario. That may sound absurdly cheap, but that's roughly where they're trading for right now. And they're a company with a lot of debt that in this case, we are assuming that they're going to decline on the top line. And if my assumptions in this scenario come true, you're looking at an 11% annualized return every year for 5 years on this stock, which is actually likely a market-beating return. Because of how levered the company is with debt, if you just give them a 7 times multiple, you're up to essentially a double on your money over 5 years. An 8 times multiple, now you're up to a 19% annualized return. So you see how quickly this number can change. By the way, their average over the recent past has been, roughly 8-ish times multiple on operating income. But I'm just going to leave that at 6. And as far as where the upside is here, if they manage to decline maybe say 2% every year for the next 5 years, that's kind of in line with what they've been doing. They roughly maintain their operating margins and free cash flow margins. And if we just give this company an 8 times multiple, you're looking at a 26% annualized return on this stock. That's more than a triple on your money over 5 years for, what I think are not that optimistic assumptions. I think there definitely could be value here, but, the reason I'm just not going to buy this stock today is I don't feel like I can put numbers into my bear case and say with conviction that I think it can't get worse than this. If top line really is declining high single digits year over year, if that's what we see in the fourth quarter, and on top of that, if they try to reinvent the brand and free cash flow goes up in smoke, then I just don't know where the bottom is for a company like this, especially considering they have a lot of debt. Their debt isn't coming due immediately, but these maturities, they're going to arrive faster than you think. So for me, in conclusion, looking at this stock, it's very easy to imagine how you could triple your money. This bull case that we put in here, losing 2% on the top line every year for 5 years, just basically maintaining your margins and having an 8 times multiple. Yeah, it's easy to imagine how you could make a lot of money in Bath & Body Works today, but I'm just going to wait. I'm going to add it to my watch list. I want to hear what management says after that fourth quarter. And, maybe at some point, this could be a stock that I have in my portfolio. But today, it's going to be a pass for me. And if you got value out of this video, subscribe to the channel. Maybe consider supporting me on Patreon. And if you agree or disagree with anything I said here, leave that down in a comment below. And I hope to see you all in another video.